Welcome to the Explainer. Today, we're going to decode the language of the market by looking at one of the most powerful tools a trader has in their toolkit, the candlestick chart. So let's kick things off with a simple question, one that's going to frame this whole explainer. What if a stock chart could actually tell you a story? You know, a story of conflict, of victory, and defeat, all packed into every single bar. Well, you see, each candlestick is exactly that. It's a little chapter in the ongoing story of market psychology. It's this incredible visual summary of the battle between the buyers, the bulls, who are trying to push prices up, and the sellers, the bears, who are trying to drive them down. To really understand this language, you got to start with the alphabet, right? So we're going to begin with the four most fundamental patterns. Now, they might look simple, but trust me, each one tells a powerful and totally distinct story about who's in control. All right, first up, we've got the hammer. I want you to picture this. A stock has been falling, maybe for days. Then, suddenly, a hammer appears. That is a huge signal that the sellers are finally getting tired out and the buyers are stepping back in with some serious force. In this slide, it lays out that battle perfectly. So the session opens and sellers are in total control, right? They push the price way, way down. But then everything changes. The buyers just storm back, they mount this massive comeback and completely wipe out all those losses, closing the price way up near its peak. It's the story of a decisive, clear-cut victory for the bulls. Now, the hammer also has a cousin, the inverted hammer. It's also a bullish signal, but the story it tells is a little different. Here, the buyers try to push the price up, but the sellers put up a fight, knocking it back down from the highs. It's still bullish, for sure, but that seller resistance means it's a weaker signal than the pure show of strength you see in a classic hammer. Okay, now let's completely flip the script. Imagine a stock has been on a great run, climbing higher and higher. Then, a shooting star appears. This is a big warning sign that the rally might be running out of gas and the bears are getting ready to take over. It's literally the mirror opposite of the hammer. And you can just feel the psychology playing out here. The session kicks off and the buyers look unstoppable, pushing the price to new highs. But then, bam, sellers come crashing in with overwhelming force. They totally erase the buyers' gains and slam the price down to close near the bottom. That is a massive red flag, a huge shift in momentum. And just like the hammer, the shooting star has its related but weaker counterpart, the hanging man. They're both bearish, and you'll find them at the top of an uptrend, but the shooting star shows a total seller victory. The hanging man, on the other hand, tells you that while sellers did push the price down, the buyers still had a little fight left in them. It's a warning, yeah, but it's not screaming at you the way a shooting star is. Okay, so we've got the core four down. But beyond those reversal patterns, other candles can tell us even more about the market's mood. They can signal everything from a complete stalemate to absolute, undeniable control by one side. So when you see a spinning top, the small body with those long wicks sticking out the top and bottom, it's basically a sign of a tie. Both the buyers and sellers fought their hearts out, but neither one could get the upper hand. The market is just pausing, it's uncertain, taking a breath before its next big move. And then there's the doji, which takes that indecision and cranks it up to 11. The open and close prices are pretty much the exact same. It's the ultimate symbol of a market in perfect balance, and that often means a turning point could be coming. Think of it as a blinking yellow light warning you that the trend's conviction is starting to fade. Okay, now this is the ultimate power move, a marubozu. It's a long candle with little to no wicks at all. What that means is one side, either the buyers or the sellers, was in complete, total, absolute control from the opening bell right to the very end. There was no fight, it was a pure knockout. So this chart just gives you a really quick way to visualize the power dynamic we've been talking about. At one end of this spectrum, you've got the marubozu. That's total control. At the complete other end, the doji, which is total indecision. And somewhere in the middle, you have those powerful reversal singles like the hammer. All right, look, knowing the patterns is one thing. That's half the battle. But applying them wisely, that's the other half. And to do that, there are two golden rules you cannot forget. These are what separate real analysis from pure guesswork. And the first one is huge. Context is everything. A pattern that looks bullish means absolutely nothing if it shows up at the top of a long uptrend. In fact, it might even be a bearish signal. A pattern in the wrong place is basically a useless signal. Seriously? This slide right here? This is your cheat sheet for the most critical concept in all of this. Look closely. The exact same shape has a different name and a completely different meaning depending on where it is. That hammer shape at the bottom of a downtrend, that's a bullish hammer. But that very same shape at the top of an uptrend, that's a bearish hanging man. Location changes absolutely everything. And here's rule number 2. This is the one that's all about discipline. You have to wait for confirmation. Why? Well, because a hammer is only a potential buy signal. The proof, the confirmation that the buyers are really in charge, that comes when the very next candle actually closes higher. If you act on a signal without confirmation, you're not trading, you're just gambling. Okay, let's put all these pieces together. We're going to take this theory and turn it into a simple, actionable blueprint that you can actually use to plan a trade. So here it is, your 3-step plan. Step 1. You spot a valid bullish signal, like a hammer after a downtrend. Step 2. You be patient, and you wait for the next candle to close above the high of that hammer. That's your confirmation. And step 3, you enter the trade, but, and this is critical, you immediately place your stop loss just below the low of that hammer candle. That way, you've defined your risk right from the get-go. And I cannot stress this next part enough. Trading is about managing your risk, not about being right all the time. Your stop loss is your seatbelt. It's your safety net. It protects your capital when a signal doesn't work out, and believe me, sometimes they won't. Your discipline here is completely non-negotiable. So, if you only remember 3 things from this entire explainer, make it these 3. 1. Read the story in every single candle. 2. Context is king. Location determines the meaning. And 3. Always, always wait for confirmation. Look, we've basically given you the alphabet and the grammar of candlestick charts. You can now read the story the market is telling you every single day. The only question left is, what are you going to do with that knowledge? The next step is all yours. Go open a chart and start practicing.